before I do my introduction, Tim is one of the best strategic advisors, theorists, actions guys when it comes to helping businesses grow. So I just want to say that. So it's great to see you again 2 days in a row, Tim. So by my introduction, I'm the co-founder and CEO of Growthink, which next year will be our 25th year in business. And our core business with companies of all types and sizes is on their growth plans and their financing strategies. And from that business, we have a number of other more financial services related entities. We own an investment bank, Growthink Capital, raises money for companies. We own a broker dealer, GT Securities, where we have 150 odd independent investment bankers all around the country and the world that clear their securities transactions on our platform. And as of this year, we now have an asset management firm, a registered investment advisor, GT Investment Management, that helps kind of what I talk about, we call it the business of money, and connecting the business and the personal when it comes to looking at how entrepreneurs, executives, those involved with private equity, which entrepreneurs are, sometimes they don't realize that. They think that's something, even if they're running a small business, that is not what they're involved with, but they are. They're in the arena of private equity, and helping to build private equity strategies that involve not just making money on our own work and our entrepreneurial effort, but thinking about our overall balance sheets as business people, some of which is the vast majority for most entrepreneurs is involved in equity in their own businesses, but strategies to access equity in other businesses and build a strategy around turning all the hard work and goals and dreams and ambitions into a lot of money. So that's what we do. So the last 25 years, every day, involved with companies big and small, and I think as importantly, entrepreneurs and executives, and seeing so many of them be fantastically successful, and then recognizing that everyone, no matter where they are on the journey, right? And we honor the journey at all times, whether it be starting a new company, and the journey never ends. The journey is the reward. The journey never ends. So, my biggest heroes are those that do fantastically well with their businesses and have money for make money for multiple generations of their kin, and just keep at it. I love it. I love that. So I would say that this is something that I will do to my dying breath. I love it for working with the whole process of the strategy of growing businesses, and then the individuals that are involved in it and why they're doing it. What is it? What's driving them? What are the personal challenges they're overcoming? And it all stays the same. Tim and I, we're working with the CEO of this company is fantastically wealthy individual in there, 3-day strategy meeting with his team, and trying to climb the next mountain. So, and he doesn't have to do it. What drives him is very interesting, but my view is it's a blessing to all of us that folks like that continue to go, because they have so much expertise, so much to offer, and the arena that they can offer in it is growing great private companies, for-profit companies.
Yeah, thanks, Joe. That's awesome. That's a great overview. So I was putting the theme on this call as positioning for success in 2024. Last couple of weeks here, we're having a good dialogue about December is actually a pretty good time to get some business development done, because it's not over until it's over. But I think we could put a bracket on those conversations. I want to talk about the new year, and potentially some predictions for what we should be anticipating in the new year, and how we can position ourselves as business owners, advisors, people. There's plenty of people here that advise other businesses. So what if you had any kind of mini predictions for the new year for business? It could be the geopolitical landscape, it could be AI, it could be, you name it. I'm just curious to hear your thoughts on that.
Well, I think that for sure the biggest factors in any company are all the micro and the executives, the leadership, the entrepreneurship, creativity, the innovation of the individuals leading companies. So that's always, it doesn't matter. Like every market's a good market. So, there's like, there's never any, it's always on us. It's always on us, no matter what the conditions are outside. Having said that, it makes it easier when the tide is rising. And the last 2 years have been, the factors related to the private equity arena have been, there's been headwinds. The biggest one being access to capital. Now, 21 was an outlier year because of the pandemic, but still, if you look at venture capital financings, M&A activity in 22 and this year, down 30 to 50% in both years vis-a-vis 21. So just it's been, and that then has translated, and there's also a feedback mechanism with lower business and consumer confidence, obviously higher cost of capital, higher interest rates, inflation. So you've had a lot of macro factors that have been very unfavorable, which we all feel personally and for businesses over the last couple of years. Now, we've seen that start to reverse itself. November was the best year in the public, best month in the public markets in a couple of years. The stock market was up. The S&P was up almost 9% in November. We've seen some interest rates are coming down. Business and consumer confidence are keying up. And my thing is, I just think it's a regression to the mean. Now, if you have 2 years of 30 to 50% down in terms of financing activity, that odds are high that 2023 from that lower base have a pretty good probability of moving up. So that impacts a lot of things. When you have times, if you think about times when you have really solid private equity financing markets, a lot of venture capitalists, angel investors, private equity, family offices, strategic, when they're putting money into things, that creates, certainly it just creates the opportunity to access capital and grow with other people's money. But also it's just it's like a signal that creativity, innovation, new things there's a receptive landscape for them. And the biggest challenge I think that any company has, just the apathy of the marketplace. Like, you do all this work, you put the product or service out there, and it's crickets that come back. And that's how the market generally, it's not hostility, it's just apathy. And my strong sense is in 24 that we're going to have better receptivity in the market for new products and new services, and for those that are raising money. So many deals, no matter how good they were over the last couple of years, have just been dead on arrival because of the market climate. Because of these kind of macro factors, that feels pretty likely it's gonna change in 24. We're gonna have some tailwinds.
Yeah. What you mentioned leadership. It's always a big one, getting the team right, the folks on the bus. What's your take on the remote work environment in the new year? I know we were talking about this for a minute and everything that's transpired with WeWork, and I think you're at a WeWork right now.
I am at a WeWork, yes. We're in
WeWork.
Playa Vista.
What's your take on the remote work environment?
I think it's one of the more interesting questions that we have to continually ask ourselves as entrepreneurs and executives. I think from a personal standpoint, from a work-life balance standpoint, I think we all love it. We love the freedom of choice, and it's just great personally. I think we have to be realistic that human beings have evolved over millions of years, right? And that there's nothing that compares to having people together. And Tim, you can comment on that from yesterday. How many calls have we done, strategic planning calls with this team over the past year? Dozens and dozens of calls, and it was great. But what we did yesterday, 4 hours with all of them in a room, there was magic in that. And so I think we got to be, we really, it's very, very easy. And this is great. Zoom is great. This is an incredible forum. But again, if we were all sitting in a room together, it would just be a memorable experience, right? Yeah. Like this is great, but this is something to think about.
Yeah, I mean, when
it's harder.
some of the
Mhm.
folks in the room we've known for so long, you walk in and you're hugging.
Yes.
Like you can't hug a client on a Zoom call, and that goes a long way.
So it's hard to, it's almost like, it's one of these things. It's like going to a party. You're like, it's fine. Thing. I go to bed early, I go to a party. You get there, and then it's almost always a great experience, right? There's always that reluctance, but and again, it's very easy to, and we did notice, by the way, one of the key people in the company, the CFO of that company. So there were 16 people in the room, and there was one person on the Zoom call, and it just doesn't, it's not the same. So getting together in person, it's something we all have to think about. Our company has become very virtualized. We have people all over the world now, and it's something that we talk about, and we got to figure it out. I would just argue that we're not going to go back into the office 5 days a week, but more effort, and it's going to take. It's like working out. So it's going to take proactive effort, because you can always rely on Zoom and on email, but you're gonna lose the magic. You're gonna lose the magic.
You made a comment the other day. I don't know where we were. You make a lot of comments,
Yes.
but it was about, you said it's an age-old thing where these organizations, especially these mid-sized, large organizations, are always going to need the human advisor. They're always going to need that outside third-party perspective for someone to come in and kind of shake things up. Why is that? Why do you feel that is?
I think that so organizations are a collection of relationships, and anyone who's worked in an organization of any size knows that very quickly those relationships get almost solidified and anchored in a certain way. And the boss, the manager, the people that are reporting to them, the co-workers, it becomes this ecosystem that gets very solidified, and it gets to a place where it takes a very special person within that organization to be a champion of change. And candidly, in the modern environment, most of those folks, they go out and do their own thing. So, this group, I imagine you get a lot of, the owner operators here, the CEOs are on this call, and so, obviously these folks need to drive the change, but to the degree to expect to be able to bring in folks into the organization to do so, I think we have to have realistic expectations on that. And so that's where, bringing in an outsider can be a catalyst, and that person has a certain star power coming in from the outside, and if they're good, they can, help to break the existing paradigm. And we use the example from yesterday. This is a company that has an existing IT system in place that's on a legacy platform from literally the 80s, and it's been obvious for years to everyone that they need to make a transition on that tech platform to lead their company into the next 10 to 50. There's no way they can have this platform 10, 15 years from now, and no API connection, no ability to do anything with integrating with its marketing, kind of a DOS system. Everybody knows it, and just Tim and I being in the room with the executives to be able to have them as an outsider to say this has to change. Just there for 10 minutes for us to say that, which was obvious to everyone, got them to agree to making this change that they've been resisting literally for like 10 years. Yeah. And so there was nobody in the organization that was going to put their neck out to make that change, because most people in the company, they're getting paid. It's additional work. The CEO is not a tech guy, so it's hard for him to actually do it. He could say, bang this hand on the table and do it, but he can't do it. He has to get the people in the organization, and there's politics. I may make one point on that, Tim, that being the CEO, in terms of the power, it's actually quite underrated. Like, even though you're the boss, and you own all everybody's what you pay, it doesn't really, people can block you, and yeah, you can invest a lot of energy And yeah, in the end, you can really have your way if you want, but you're going to win that battle, but you're going to lose the war. And it's very personally taxing.
So
That's where
what
the
does,
outside advisor helps.
no, I love it. What does it take to be a great CEO?
You know,
Many different shades.
the best ones that I've met, and I've met a couple, one that we worked with that started out with us with a business plan. It was a $10,000 business plan we wrote for them in the early 2000s for him. He built a company into one of the largest professional service outsourcing firms in the world, over 4,000 employees. And he was, you know, his background is actually, he went to medical school. He studied as to be a doctor. So he very, very talented, looked at his organization as an organism. Now, you know, something unhealthy in one piece of the organism would affect another piece. So I would argue that in this day and age, the best CEOs are strategists. They're responsible for getting the company focused on the right opportunities. Yeah. And that's their number one responsibility, is making sure that, you know, hard work is great, but the world is littered with, you know, incredibly hardworking owner operators that don't get anywhere because their strategy is off. So I would say that if all the factors, you know, the traditional ones, you know, charismatic, all that, that's all great, but that the CEOs who get their businesses focused on the right strategic path, they're the ones that long term will have the highest likelihood of having success.
Yeah. Yeah. We always talk about increasing enterprise value. Increasing the enterprise value. I kind of feel like the CEO's job is to be the strategist as it relates to increasing the enterprise value and bringing in the right people that can add to that mission of increasing the enterprise value. There's plenty of owners out there that want to keep it tight and keep it small, and I have this conversation constantly. Love to hear your opinion on this. It's kind of the two schools, right? You have one person that says, this works for me. It's a lifestyle business. I got my small batch of employees and it's fine. And I can do everything I want to do. Then you have folks like the gentleman we hung out with yesterday, and he's like banging the gavel on the table and saying, you know, we're going to take over that mountain. And we have to get to that mountain because behind that is an even bigger mountain. We can't get to the end. He just wants to grow, double down, grow enterprise value, legacy for the kids, the whole thing, right? So it's kind of two different schools. What's your take on, you know, keeping it small and tight, or doubling down, increasing enterprise value? And, you know, why would someone want to keep it small and tight and lifestyle? And is that even possible in an environment? You know, these are questions I have constantly. It's like, what's the right strategy there for an individual business owner?
Well, I think, you know, the traditional answer is, well, you know, hey, it's your thing, do as you want. You know, that's the traditional answer. I'm not a big fan of that answer. I would argue that what most of the folks in closely held companies, they own most of the shares of the company. So they are the number one shareholder in their companies, right? They own 100% of the shares. So they have the CEO role where they're working. Again, these are the CEO. It's not some, you know, glamorous title. They're doing all the work. They're working harder than anybody. That's like, you know, it's not like there's not Jamie Dimon at JP Morgan going on CNBC and opining and going to Davos. That's not what it is. Okay. It's a lot of work, right? But they're also the chairperson, chairwoman of their companies. And as the chairperson of the board of directors, they're responsible for the shareholders. So, you know, I was listening this morning and they're talking about, you know, the CEO of Ford having the stocks at $10, and because, you know, they're losing all this money on EVs and they're trying to get the stock to 14. This is what a CEO of a public company has. They have shareholders, and they have to answer to the shareholders. And so they have a fiduciary role by their board of directors that tells them, you need to get the value of our shares up. Now, as the CEO, you have that same fiduciary responsibility to your shareholders. Now, the shareholders happen to be you. You're the shareholder. So you start looking at the value of your thing. And, you know, again, let's look at it this way. Most CEOs are very thrifty, very thrifty. You know, they're going to talk to, you know, HubSpot. They want to get a little bit off of that monthly subscription, or, you know, they're going to make sure they're going to get the discount ticket to the conference, right? They're going to, God bless it, right? They're gonna, as they should be. Thriftiness is a virtue. At the same time, they got this gigantic piece of equity in their companies, and they think about, all right, this thing is worth something. Now, I believe just having a company, just any business, just having a business, incorporate it, a structure of it, just any business, in my opinion, just that alone, it's worth $1 million with nothing, with no customers, no, no profits, just by taking the step of saying, I am going to make a bet. I'm going to start a company. I'm going to get a brand. I'm going to work the whole thing. It's worth $1 million. Okay. So now you say to yourself, all right, if I can figure out a way to grow this, and the expectation should be a minimum of 20% a year. That's the average rate of return on private equity. It's 20%. I can go into a long conversation. Everybody thinks it's less. It's actually 20%. 20% per year is how much a private company on average grows. Now you got a whole bunch of them that fail. Okay. You got a bunch of them and that's actually overrated. Most of them just don't grow. Most of them don't fail. Most of them don't grow. Once you get it set up, they tend to stay in, they tend to stay there for a long time. And the vast majority of them don't grow. But to the degree you get that $1 million asset, grow at 20% a year, you look at it, you say, man, this thing, like if I'm not thinking about myself, I got $200,000 a year right now, almost $20,000 a month, $5,000 a week if I'm focused on growing this business. So you got to say to yourself, what are my opportunity costs? And the thing I always say to folks is, oh, you want your life. I said, something, how about this? Hire a psychotherapist, okay, to deal with all your lifestyle issues, all the rest of it. And spend a couple $100 a week on that. And with the rest of the money, grow the company.
Wow. I love it. I love it. You dropped a lot of bombs there. That 20% PE per year-over-year growth. Because I think the thing is you're trading your life. You're trading your life for this. You're trading life units to invest into a business. So you have to make it worth something. And you have to show up intentionally. You can't just show up and hope the thing, grows. And that even goes into like exit plans, because I'm curious to get your take on this. I've heard a lot of people say, well, my business is worth X. You're like, yeah, if there's a buyer, right? Just because you want to sell doesn't mean you can either. So most people don't think I know your partner, Dave Levinsky, wrote a book called Start at the End, I believe. Let's just give me an opine just briefly on starting at the end and having a good exit strategy, whether or not you intend to exit this year or next year or 5 years or 10 years, just thinking about the end as you build your business.
Well, that comes down to the number one role when we think about strategy. So putting on that chairperson's hat, chairperson of the board of directors, and thinking about what are the factors that drive the growth and the value in the company, and putting time into that, you start realizing some things, and in terms of what are the aspects of companies that have value in their equity. And the things that some folks, by the way, people know more about this than they think. They don't necessarily have to hire an outside advisor for this. It's basic things that folks know. Like most folks know that having diversification of customers is like just a basic thing, right? Like you have one customer, obviously the value of the company is very fragile because you could lose that customer, right? So you want to have a lot of diversity of your customer base, right? That's like a number one thing. Some degree of predictability of revenue, okay, which is a huge challenge for most service businesses. They put projections together, and it's very hard to really have conviction that what is the likelihood of those. So that's something we got to put time. Again, none of this is easy. All right, I'm not saying it's easy. Again, it is what it is. It's not easy, but getting some predictability of revenue is another factor. And then there's obviously systems. Then the thing is the hit by the bus, Tim, which you can speak about. We did a lot of time on that yesterday. The hit by the bus plan.
Yeah.
And I was very impressed with this company. I got to give them a lot of credit, right? They put, these are folks that get paid well. They have families that are very dependent upon all the executives and the money that they make at the companies, and they all have a hit by the bus plan. And maybe you want to explain that, because I thought that's a very powerful.
Actually heard that about
way to think about it.
I heard about it a decade ago, and anyone who's worked with me over the years knows that we always talk about getting hit by the bus, but it's real, because we're not going to make it out of this thing alive. And no one can run their business forever. That's just a pure fact. So you cannot run your business forever because you don't have forever. Therefore, that means if your business is going to exist in any shape, form, or fashion, you have to have some kind of what happens if I don't show up tomorrow plan. What are the steps? How do we take care of our customers? How do we take care of our employees, our partners, suppliers, or vendors? We can leave everyone high and dry? No, that's unethical, right? So it's the most ethical thing you can do is have a what happens if I get hit by a bus plan.
And okay, now this client is also is a great inspiration. What he actually did was when he was in his, to his eternal credit, when he was in his early 40s, he set his 55th birthday as his freedom date. And that was a date where he was only going to work if he had to work. But to your point about lifestyle, that this piece here is the perfectly aligned goal, because on one hand, you're actually building value in your company. And the second thing he's doing, since he's done that, this guy, he spends literally 3 to 4 months out of the year luxuriously traveling the world, because he's done a very good job of putting together the partial hit by the bus plan of him. He has people in place, and the business is strategically sound enough to have the margin and the cash flow to do so. And so he has the best of both worlds. He's got freedom, he's got work-life balance, and he's got a company that has significant equity value. I believe that has to be the goal. That has to be the goal. And so this is where, like, it's not a false choice. By putting that thought process in place, you're putting yourself on a path to eventually work more and more on your own terms and not be the chief bottle washer in the company, while at the same time building value as the #1 shareholder in your company.